guys, good morning, good afternoon, good evening, anywhere you are around the world. This is Agatech FX. All right, today we'll talk about the pennant, what is called a price pattern. So I'll talk about a lot of some price pattern that you can use in trading for forex market, or in trading any stock market, or in trading indices market, right? So in my videos, I have a playlist where you can be able to watch some lectures which you can get yourself enlightened more, and I can share, like, subscribe, and as well I will talk about price pattern. We have a lot of price pattern, and we are seeing it in the chart, right? So the first one I'm going to talk about now is the pennant, right? So as the market is pausing, what I mean by pausing is when market is trying to halt, when market is trying to come, is range bound, like ranging in a very low form. When there's a sharp move, with market begins to range. It's, for example, now when you want to close when you keep your hand in an angular form and try to touch your fingertips together without allowing your palms to come together. That is what we call when market begins to range and squeeze itself in that manner. So we'll find price retracting into a narrower and a narrower configuration, right? So it comes together and forming a squeeze. So the market squeeze itself from both top and bottom. So from both the bullish side and also both from the bearish side, they are all coming together to form a squeeze. So this pennant pattern will show up just before the market takes off in its original direction, right? So you can see these things mostly when we have NFPs, these very high impact news, right? So but prior to the formation of this pennant pattern, the market creates a pole, right? And an aggressive move that leads into this pattern itself. All right, let's take a look at this. The left hand side here, you see we'll call bearish pennant, right? So in this bearish pennant, we'll have markets came down aggressively, right? A bearish market came down aggressively and came to a support area, bounced up to a resistance area, bounced down to a resistance support area, and bounced up to a resistance area too. So the higher are becoming lower and the lower are becoming higher, right? So the market begin to squeeze to this extent, and we have a breakout. So we have at least 70 to 85% or 90% probability that the market will continue in its original direction, right? What I mean by original direction is this: market is dropping, begin to range bound. We have a 70 to 80% tendency that the market will continue its move downward. That we call bearish pennants, right? Now, for bullish pennant is opposite of this. When market comes up, if the high momentum pulls up, hits a resistance area, bounce back again, support, resistance, support, and began to squeeze to itself, right? So the higher are becoming lower and lower are becoming higher. We have some different kind of price pattern you can see when market is range bounding, having the same levels, right? We'll get to that level, we'll get to that price pattern where you understand what I'm trying to explain. So this is exactly what pennant pattern is, and I'm going to show you guys this on an actual chart, and what you need to know before you begin to trade this, and how to calculate your risk reward before you push into the market to trade this kind of pattern. And this kind of pattern appears in the market. So next thing is this. Now take a look at this pennant formation, right? So say the widest part of this formation becomes the target, right? So if you want to trade this pennant pattern, what you need to do is to measure this sharp move, the pole, that is POLE, the pole. So measure it, assuming this place from here to here is 100 pips. We have at least 70% to 80% tendency that market will do that same move when it breaks out from that area, right? So if this is 100 pips, we are expecting another 100 pips here. So you don't just target 100 pips if you're trading this. But take note, we'll have some liquidity being below here, because this is a chart structure. We'll have some liquidity below this area where markets will tend to either mitigate or take out or break or retest before continuation, even if it wants to go bullish, right? Or if it wants to trace and continue downtrend. It's still applicable to bullish, right? When the market the pips, the wide range of the pole, wide range where the market tends to measure, that's when you draw your trend line, you measure the pole, the range. Now we have the high tendency that the market is going to do break out towards that area and do the same pips and that same move we'll have. right? So when you see this price pattern in the market and have a breakout, measure the previous move and push into the market. Reason because most of us do see this kind of move in the market. When the market breaks out, we forget that this can maybe this move here over here or this move over here will give us like 50 pips, right? Maybe on a higher time frame or maybe on 1 hour or 4 hours, right? So when we see this kind of thing and market breaks out, we'll just wait. Okay, let's enter. Let's hold. Let's let the candle close before we enter. You wouldn't mind to check how many pips the pole is the momentum of the market that came down towards that area before forming that squeeze, right? You didn't check that. Then it may do that same 50 pips here and begin to retrace back. That is what most of us call it fake out, but not knowing that it just did that same move it did above this area before what retracement, right? It's applicable to that. So let me show you this on a natural chart so you can be able to understand exactly what peanut is. Now this is a peanut in a bearish what pattern. Take a look at this. That's a pull, right? It's very high momentum market move, right? This is fundamental, right? Okay, now let's look at this. The market came down, formed a low. The lower became higher and forms the higher and became lower, right? Now take a look at this. If you measure this area where you draw the trend line and measure this area, you see that the same pips here is what you can also get here. So we have that pull, we have that squeeze here, and the market did what? Market broke out this area and what began to go down trend, right? So that is it about a bearish pennant, right? So a breakout moves downward, the market closes below this line. Some people will jump into this trade when they see the market move. So allow the candle to close below, they can enter a trade. Then selling from this area, there must be a price aside it, because this is 15 minutes time frame. You can check 1 hour. There is a block, other block, or breaker block, or mitigation block, or a price that this market is trying to do what? Push to mitigate, or push to take out, or push to liquidate before what? Continuation of this trend, or continuation of uptrend, or whatever you see on the chart, right? So let's take a look at a bullish pennant. All right, take a look at this. Then we'll have a bullish move here. We'll have a buy bullish move here. Then the market begin to bridge bound, form the resistance area, dropped from the support, from resistance area, the high become lower, higher low, and the low become higher, lower high, right? Now we have a squeeze here, right? We have a squeeze here. Then when you take a look at this, the market broke out this area. What happened? Well, it broke out this area, ranged bound before it took out this area. So if you check this price from here to this area, it is similar from here to this area. If we have 15 pips or 100 pips here, we'll have 100 pips here or less, but it will exceed that. If it's 100, it will exceed like 50, 60 pips. So you can use your Fibonacci. If you know how to use your Fibonacci, I will still talk about Fibonacci in upcoming lecture, so you understand how you can work with Fibonacci in trading a pennant, right? So that is that about pennants, right? So don't forget to subscribe, don't forget to share, don't forget to like this video, and watch out for the next lecture, because I'll be giving it bit by bit, so you're able to understand what price patterns are and how you see it, when to see it, and how practice with it on your actual terminal, which is the MT4 terminal. You can also practice it on your MT5 terminal, right? If you want to see a video on where I explain about how to use MT4, if you are newbie into MT4, there's a video on this channel, on this my playlist for forex mentorship. The first video or second video will see how to use MT4. I try my best to tell you how MT4 is easy to be used, and from there you can begin to pick up till this to get to the 8th stage of understanding charts and other things. Flag pattern. So all these are continuation pattern, right? I think I'm going to talk about like 4 or 5 continuation pattern. From there, we'll move into neutral pattern. From neutral pattern, we'll move into continuation pattern, reversal pattern. Sorry, guys, reversal pattern. So the flag, right? So a flag pattern is what we call a take a break pattern. You understand what I mean by take a break? If you're working on a company, you work with somebody, you want to take a break. There's always a break time, right? So this kind of pattern generally will start off from a large wick move in one direction, forming a fairly steep pole, right? You can start from bullish move, you can start from bearish move. You can see that in a high impact news, you can see that in a sharp move in the market when maybe we have a consecutive like 4 or 5 news happening at the same time, you can see a sell signal, or buy before it begins to range bound, right? So after that fairly, take a break move, then there comes a flag formation, and it's gently what zigzags upward or zigzags downwards, as you can see on this, as you can see here, right? Slightly, and this zigzags move slightly against what initial move, right? So if market is coming downwards, a sharp move from downward is slightly, zigzag upward a little before continuing what the downtrend. The same thing applicable to bullish before continuing what to an uptrend, right? So to be a two flag, the formation takes place between two equal separated lines. So you can use your trend line, though we have some indicators around there that is called channel, right? Channel indicator that helps you draw the channel on the actual chart, right? So this equal lines formation forms a small support and resistance channel, right? So the bear flag is formed as a slightly rising formation, while the bull flag is formed slightly falling what formation. So this is exactly what I explained here in the video. When you have a sharp move downward, we'll have an high impact news. We have like 6-7 impact news coming towards the market, but getting bearish, and we have a halt forming a support zone, then have a bull, the market bounce up again, have a resistance zone. The lower are becoming higher and the higher are becoming higher, right? So when you use your trend line, although we have, as I said earlier, we have a channel indicator. You can browse channel indicator. You can download a lot of it from the online or from Google, any place you want to download it, and or you can use your trend line to draw this, right? So when you draw this trend line, we have that slight, a small separated line, something like this. You can see here how we have a support and resistance being range bounding. So when we have this downtrend, the market trying to range bound upward, small a little. But take note, this may tends to do what? Have a fake out, right? Tends to range bound upward, and what happens? It breaks out and continues what? Its downtrend. That's why I call this a continuation pattern. The same thing applicable to bullish. Markets aggressively come up with a high momentum, hit a resistance area, then range bound again, bounce again to a support area, come back down as if it's coming back towards that, as if it's coming back towards where it's coming from, towards the bullish move. What happens next? It breaks out this area and go and continue what? Its movement, right? Let's take a look at the next slide so you can be able to understand what I mean and how to trade it. Now, this is the flag we're talking about. So when the market is selling, a sharp move, we have a range bound. Now, we have if we measure from here to here, let's assume we have like 30 pips or 40 pips from here to here. We have a high tendency that the market will keep making this move, and when it breaks out, it's going to make this move. It's going to make that 50 pips from here and make that 50 pips from here before retracement, or before begin to before the market to begin to continue anywhere direction wants to move, right? So that is how you can be able to have a risk-reward ratio and know how to push into the flag market or flag pattern and trade it. It's something applicable to what? To bullish flag pattern. So you can use a channel to do this. You can use a trend line to do this on your terminal, or MT4 terminal, MT5 terminal. So these are like a target, a traditional target. Like if you want to do your normal analysis, your normal technical analysis, and draw your trend line, this is the way you can be able to target that same pips or target the same move. You can also backtest this and understand what it is on an actual chart, manual backtesting, right? So let's take a look at this on actual chart, so you will be able to understand what flag pattern is. All right, this is a bearish flag pattern, right? You see this sharp move. This is a pole, right? As I said earlier, impermanence is a pole. So we have a sharp, aggressive downward trend toward this area. Then what happens? Markets begin to do what? Slide upwards, move backward, right? As if it's trying to go back to where it's coming from, right? Now, many people push into this trade for a bullish, and what happens? Markets are taking out the liquidity over here and do what? And comes back to it. But when trading this kind of a breakout, a flag breakout, what are you looking out for in this pattern? First, the market came back to what? Take out liquidity here, because you have a swing here. If you are good in SMC, smart money concept, or ICT, you can be able to understand what market came to do, came to mitigate, or came to take out this area, a void or a gap here, and also a gap here. We have a market here. So market came to do what? Do mitigation or take out this liquidity and do what? continue the breakout and continue what? The downtrend. That is what we call a bearish flag formation. See that? Like a bearish flag formation. Okay, let's take a look at a bullish flag formation. Now, this is an aggressive move where you can see a market that is bullish. Maybe we'll have a bullish market move here, where the market aggressively goes up. Now the market now bounced out of this resistance area, begin to come back downwards, trying to cover this trying to cover this area, maybe trying to correct that move, right? It is trying to correct the move, right? So here we have a swing, here we have a gap here, which market tends to cover, right? So what happened? Markets range bound down to this area. What happened next? It broke out to this area, and what happens? The market continued to uptrend. So that is that about the bullish and bearish flag formation. So in trading this, you have to be very conscious of it. You have to measure when you see this kind of thing in a chart. Use your trend line or use a channel which can be able to show you what this is all about. Then measure from here to this area, you see your Fibonacci, and measure from here to this area and know if it's the same move that it made from here and it's actually the same move it's made to this area. Alright, so that is how you can be able to trade flag formation as bullish and bearish flag formation on an actual chart. Rectangle pattern, you can see that on your forex chart, be it currency pairs, indices, stock, or any even cryptocurrencies, right? You can see this on an actual chart right? So a rectangle is a price action that can sandwich between two horizontal lines, right? Or that support or resistance level. So you can see this rectangle forming a level of support and resistance which are unequal. So we'll find this rectangle after a big move from the upside or from the downside, right? So one market is coming from the upside, which is coming from the bearish side, the bullish side, dropping down to the bearish side. You can see this rectangle forming. Or when it's coming from the bullish side, you can see this rectangle forming up, right? So this rectangle can be formed when the major market participants go to sleep on a smaller time frame, right? Rectangle are generally period of equilibrium, right? So in this rectangle, you can be able to find it on every chart where a range being formed under a support and resistance level being equal level, right? So a rectangle can be very narrow as it consolidates in the market. We see this in the consolidation market, or we'll call it ranging market, having the same equal high and same equal low. Or also, you can be able to see this in an actual price movement. It can be wider, it can be smaller, it can be narrow, it can be wider, right? You can see this in a wider form where we have a range of, when you try to do your order flow, either from the higher time frame, maybe from weekly down to 1 hour, you can see a range of any support and resistance from the low higher time frame, maybe 4 hours, and narrow it down to 30 minutes or 1 hour. Then you can see where the market is ranging inside the same support and resistance zone, right? But when it breaks out in a higher move and goes towards that direction, right? So this is a classic formation for a breakout type of trade. So if you take a look at this left hand side, called a bullish rectangle formation here, you can see the market of a bullish rectangle will move from below with high momentum moving up, right? The bullish move, a bullish momentum, then began to range, forming a floor of resistance and support area, right? As it range, it has the same level of support, it also has the same level of resistance. So we have 80% possibility that the market will continue to upside on its original direction, right? So it's not applicable to bearish rectangle. When you have this bearish rectangle, the market comes down from the downside, right? Now when it comes down to this downside, it begins to sideways, forming a point of support and resistance, or point of supply and demand formation. So this sideways is actually formation that we can sandwich in order to pushing in a trade. So when this comes down, we have a 80% chance or probability or possibility that the market will continue its original downtrend afterwards, after its ranging pattern, right? So that is and the next one I'm going to show you how you can be able to trade this, and how you can be able to set your take profit or stop loss using or trading with rectangular pattern. Right, take a look at this stuff here, right? The market is coming bullish, begin to range bound, and range consolidate inside this band and breakout. So if you want to take a profit target when you have a breakout, you use the rectangle point of support and resistance. So if here is 100 pips or 50 pips or 30 pips, when it breaks out, we have to target what, 40 or 30 pips, depending on the height below the rectangle. So if we measure our height on the natural chart from here to here, and measure the same thing from here to here, we'll have a profit target similar to this, right? But I'm not saying it should be the same thing, but maybe far more higher than this. If this is 100 pips, you can have 150 pips here before continuation, or maybe before retracement. And you can also check on your actual chart if there's any liquidity or price that market is trying to take out on that area. The same thing applicable to bearish rectangular traditional targets, profit targets. Same thing applicable to here. Measure the profits inside that support consolidation pattern, and when it breaks out, you also target that same profit and get out of the market. So let's take a look at this on an actual chart. All right, initial pull, right? From here, the market drops down, with that aggressive move, and what happens? It begins to go at range bound, forming equal highs and equal lows, right? Having some support and resistance area. So normally we call this a price range, like a consolidation area where market tends to do what? Come back and retest again. So when we have this area, normally in an actual chart, when you see this area, we have a high tendency the market to maybe go down, come back and mitigate or retest that area, right? So take a look at this. This is what we call bearish rectangular formation on the real chart, on an actual chart. So the market drops down to this area, begin to do what? Form an area, consolidate in a rectangular form, forming a support and resistance area, which is this, and this, right? So what happened next? The market broke out this area, close below, and did the same move around this area. Now, if you want to take the profit from this area, you can measure this area, for safety. You can measure this area when you have a breakout. Measure this area. If here to here is 40, you can measure this one too, and measure this one too. So if you have too high tendency of measuring from here to this spot, it may give you 100 pips, and you can target from here to 100 pips, and you're out of trade. Or you can measure this area inside this box, which is maybe 50 pips. You can also target closes below, target 50 pips from here. You can set your take TP. Maybe you may move out from the market, right? So, but when taking this trade, what you need to do is to assess your higher time frame, flow from your higher time frame to know if there's a price, or if there's a mitigation, or if there's a block. That's what we call that block. You can Google about that. You can browse about that on YouTube. Or that block or breakout block. There's another block of FVG or liquidity that the market is trying to take out. As long as it closes, it is below this area, and you see the candle has closes below this area, you have a high tendency that the market is moving towards that other blocks in the higher time frame, thereby forming all this sharp move here. That will take you put in profits. All right, let's take a look at the bullish rectangular formation. So the market has an initial upward move, upward move, and began to do what? Range bound, forming an area of resistance and support, bouncing and bouncing. And if you take a look at this, it has equal heights, right? And what happened? The market closes above the candle closes. Remember, the closure of this candle should be the body, not the wicks, right? You can have the wicks take this out and come back and will not close above all this candle. That means it is not yet valid, right? So when taking a trade with this one, you have to make sure the body of the candle closes above all this candle here. Now you can target some pips here, because you may target some pips. Market may have this complete move here, and from here it will trace back downward, right? See what happened? No, so what happens here now? You can be able to pick this from here to here, measure it, and put your take profit. Or you measure from this floor to this area with your Fibonacci, and measure from here to where you can take your profit, put your take profit, right? So you have two ways of entering the market, either by 2 to 1 to 1 risk reward ratio. You measure this area. If it is 50 pips, you measure 50 pips and set your stop loss below and target 50 pips. Or you measure from here to this area again and enter the trade from here and target the same pips or less on this area in the market. So that is that about bullish and bearish rectangular formation in continuation pattern. So we have the continuation pattern, we have neutral pattern, we have reversal pattern. Channel, right? So a channel is very similar to flag formation, but doesn't necessarily need a pull into it in order to do what? Form a channel, but it comes in a bigger scale, right? So if you see a channel, it looks like a flag, but not necessarily a flag, but it comes in a large form, right? So a channel is a market that moves in one direction and the other, but maintains what we call a range-bound appearance. So it can be bullish, it can be range-bounding bullish, or it can be range-bounding what? Bearish. So the highs and the lows keep a certain distance from each other, right? So on this channel, though I'll still show you guys on an actual chart so you can be able to understand what I'm trying to explain, but I'm going to give you a highlight on how channel looks like. Though we have indicator that draws a channel. You can search about indicator online. You can get it online by its channel indicator. We have so many of them around, right? So, but the channel have forming a highs and low. It also helps us to draw a trend line across the top and across the bottom that are parallel to each other. So when this channel forms on actual charts, it forms a high. A high may be higher, another high may be lower than the previous high, and so on and so forth. So we like to see that the 2 points when we are drawing our trend line, using our trend line to dictate this channel, it's either we use our trend line or we use a channel indicator, right, that draws it automatically for us, you know. But using a trend line, a normal trend line tools on the MT4 terminal, MT5 terminal is quite good for you, so you can be able to dictate it yourself on how to draw this trend line, right? So the same thing applicable to the lower side of it. You can be able to draw dictate 2 points below the lows using your trend line tools. Then this point I'm talking about, it can be more than 2, it can be more than 3, it can be more than 4 trend lines, right? So in a channel here, we have a market coming down, right? A bearish market coming down. So we have a channel, we have the market forms a support area, begin to bounce, which bound in this momentum, you know, and you have a parallel line here. This parallel line, you can use your trend line tools to draw this parallel line, picking 2 or 3 points. As you're looking at this point here, we have like 3 here. So picking 2 or 3 points above, the high can be higher and high can be higher. So this high is higher than this, and this one may be lower than this high too. But the next one may become higher than all of them, right? So the same thing applicable here. This low is low, this one may be lower, this one may be smaller, and the next one may be lower than the previous low. So that is how you can draw and dictate your channel. Then when there's a break in this channel, we have 80% probability or possibility that the market will move the same similar way, continue that similar direction where it is coming from. It's not applicable to bullish. When the market is going bullish, it begins to range bound downward side, you know, trying to mitigate some area, trying to mitigate some other blocks or something like that. Then we have 80% possibility or probability that the market itself will move to an upside, breaking out all these highs and continue its previous or original direction, which is bullish. This is something applicable to bearish. So a channel, I think I talked about trend line. You know how to draw a trend line. If you don't know how to draw a trend line, there's a video in this my channel where I talked about ways and how to draw your trend line, dictating highs and lows, swing high and swing lows, so you can be able to learn how to draw your trend line. So let's continue with this. Now, a profit target on this using a channel. So if you draw a trend line, the range in which the support and resistance form inside the channel, it will be your target as take profit, or the pole can be your take profit, right? So if we have 70 pips inside this trend line we drew on our chart, we can target, if you have 6,500 pips here, we can target 100 pips over this area. When the market breaks out and try to continue its direction, can target 100 pips. Then if we have on the pole here, when the market push down, and we can measure it, we can also target that same move, but not reaching that similar points or similar pips towards the downside. The same thing applicable to the right hand side here. When the market is bullish on the high, forming a high, high low, then forming lower low, all those kind of thing, and forming a range of support and resistance, sloping downwards. Remember, if you are targeting bullish, the market should be sloping downwards. If you're targeting bearish, the market should be sloping down upward, right? That's how you can draw your trend line. If you understand trend line, you can be able to draw your channel, and also it's similar to trend line, but not really what it is. So a channel is different from trend line, but you can use your trend line tools to indicate and dictate this, and you can use your crosshair to measure some pips, measure the pips inside the channel, and you can also target your take profits. So if you enter this trade here, your stop loss should be above this high or previous high inside this area, because we have a high tendency the market will drop down and come back to retest that high before continuation, right? It's something applicable to this one. A breakout to the upside, bullish move, continuation of this bullish move. We have a high tendency in our market to hit here, come back and retest on this trend line, retest this place he left before continuation. So before that move comes in, we may have like 50 or 100 pips in that side of the area. Market will hit that 40 or 50 pips before retracement. You can use your Fibonacci on that area to understand how to trade using a channel. Right, let's switch in. Let me show you guys on how to do this on an actual chart. All right, this is it on a bearish trend line on an actual chart. So when you take a look at this bearish trend line, we have a bearish channel here. We have a parallel line using our trend line to draw a parallel line, picking up 2 or 3 points. When I said this in the first slide, you have to pick up 2 or 3 points. So here above we have like 4 points, which is 1, the resistance area, 2, 3, and 4. Then below support we have 1, we have 2, we have 3 points. So this parallel line looks similar. This parallel line may be close to parallel or parallel line that you have to draw with your trend line, so you can be able to pick or wait for a breakout, right? Now when the market is bullish, right, we have a breakout on this area. We can measure it from, use your crosshair on your MT4 and measure from this area to this floor. If we have 400 pips to this floor, we have to target 100 pips, right? As I said in the previous slide, now before to this one, like as I said here, and we have a profit target of here before market will retest and continue. This is what exactly happened here. Market made that same move. I think if you measure from this breakout to this area, I think it's similar to this area and this area, right? And what market did was pull back to retest that, mitigate this area or something before continuation of its previous move, right? So, or you can measure your outer pole here and measure also your outer pole here and hit your profit target. So this is it about the bearish channel entry or bearish channel formation on actual charts. All right, let's take a look at bullish one. So this is a bullish channel formation when the market tried to go bullish. So if you take a look at this now, the market's pole came down, began to form a point of support and resistance areas, forming high, sloping downwards. But we are also in this channel we are looking for a bullish move. You can see this on a higher time frame, which is 1 hour. You can also see it on 15 minutes, right? So now what happens? We have 1, 2, 3 points, and below here we have 1, 2 points. So we say it's either 2 or more points. Don't just use 1 point. 2 or more support area or 2 or more points sloping downwards on areas. We have these 2 parallel lines. The market is inside this parallel line without breaking out. So we have a breakout on this area. We can target the same pips. So if we measure this area from this point to this last point here, the pips, we can measure that pips from here to that point and set our TP. This is our target entry. So if you enter this area, your stop loss should be inside this zone in case of pullback and continuation. But make sure the market closes above this trend line. The candle closes above this. You shouldn't allow candle wicks. If candle wicks closes above this area and the body of the candle closes inside this area, you don't enter the trade. So allow the candle to close with the whole body above this trend line. Then you can now put your entry and set your stop loss and ride with the trend, maybe risk 1-to-1 risk reward ratio or 2-to-1 risk reward ratio. Set your stop loss and push into a trade for a higher move. And when making that move, make sure you check if there's a swing or if there's SMC criteria that is being met, or ICT criteria that is being met here. Maybe you have a fair value gap, you have a swing here. That market tend to what mitigate. If you can use your rectangle and draw here, you can say market came to this high here, mitigated this high and continued. And this we have also a last bullish candle, other block here. We have other block here too, and we have this one here too. But when the market has closed, but we have this, we also have this. So market came to this area, mitigated it, and do what? Continue what is downtrend, right? So if you check this upside here, you can also check this upside here. So that is that about bullish channel and bearish channel on an actual chart. Thank you guys and God bless you. Don't forget to subscribe to this channel. Don't forget to like and share this video for newbies or for advanced. All right, bye for now.